Good morning, this is Ken Long from Tortoise Capital Management with a review of the weekend trading reports for June 14th, 2014. Happy Father's Day edition. Market remains in bullish quiet conditions on an annual basis using weekly RSI 14. We just came back into the very high end of neutral from overbought with a score of 69 out of 100. 10-day NDX, looking at the shorter term market condition, we're at 53 out of 100, so right in the middle of neutral. Looking at the market mosaic, price relative to the 200-day moving average is at 7.68%. So we got about 5 2/3% cushion between bullish and sideways market conditions. That puts it at yellow bullish. The slope of the 50 is white bullish at 0.36. ADX has improved to 25.0, so the high end of neutral as far as trendiness is concerned. ATR percentage remains very quiet at 0.55%. The risk index is the 30-period moving average of the VIX divided by the 10. The score of 1.0 on that index is the threshold between risk off and risk on. The current reading is at 1.04, which puts us into risk on conditions. When you compare that score of 1.04 to the last 5,000 trading days and normalize it with standard deviation, we have a score of 0.39 on the risk Z, or the Z score of that risk index. Here you can see the 90-day histogram, the time series of that indicator, and after 3 run-ups here to almost 1.0, it's now rolled back under the 0.5 condition, and that, in my view, is sort of the end of a long, extremely quiet condition in the marketplace. And so we saw a little bit of a VIX spike over these last 3 or 4 days. No change to the blended monthly rebalancing holdings, and the next one is due to be on or about 1 July, excuse me. And then these are the current leaders of these different trading populations based on the current reading as of Friday. In ETF2, the theoretical exposure is at 100%, and the model portfolio is also at 100%. These are just a quick look at the blended monthly rebalancing portfolios for some of those, the 13 and 32 ETFs. You can see Latin America and Brazil are at the top with everything on a buy signal. And then in the ETF Max, which looks at about 1,300 different ETFs, we still see domination by Italy and select energy sector. You can see how good Brazil is doing in here too. I like the ones that are green and white. Green on the 3-month, white on the 6-month, because that suggests there is the strength is recently emergent. Similarly, this Templeton Russell green and yellow is a extremely emerging. Whereas if we look at the long commodity ETN, the fact that it's yellow and green suggests that that thing is already topped out. This is the a look at the S&P 500 by component and then by which sector that they happen to be in, also looked at through that blended monthly rebalancing lens. And so something like ConocoPhillips in the energy sector should get your attention, as does CenturyLink in the technology, and Pioneer Natural Resources in energy, and Lorillard among the consumer discretionaries. Things like Forest Lab have marched their way back down after an extraordinary 6-month run. It's really cooled off the last 3. So I like to see the front end green and then the back end white. Now looking at the market health check, the vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal red lines are support levels that used to be resistance levels and which should act as support on the way down, but if they get violated, then become price targets for a declining price. And you can see that we've left the 200-day moving average behind now, and we progressed above it. It's not even on the map anymore. The dark blue shaded area in the middle is the river. That's the 30-period Bollinger Band plus or minus 1. The lighter blue shaded area is the Bollinger band plus or minus 2. That's the floodplain. And this pinkish reddish looking rascal is the dragon. That's a 10 period Bollinger Band plus or minus 0.5, which we take as an accelerated undercurrent of the river. And you can see that's actually starting to roll over a little bit, and the dragon is completely out of the river, which is unusual behavior. In fact, in the last 5 months, there's never a case when the price up was so strong that happened. So this has been a natural turning over point here at this intermediate high up around 195.5. You can see price had gone all the way outside of the floodplain for a while and couldn't sustain that, and has now retraced all the way back to the edge of the river. Now this is a natural place for it to find support. You can see it's right at the bottom of the 10 period regression channel, the RAF regression channel, which is in blue. The regression line itself is the blue line in the center, and then the channels formed by the maximum excursion during the look back period, and it's finding support where it should naturally find support. The fact that there's one of the parabolic stop and reverse dots above just reminds us how vulnerable this can be on an extended move in the market, and so a pullback to the Bollinger Band mean would be absolutely normal. It would be a sign of strength for it to find support at the edge of the river and then continue to move. You can see it found support here at the edge of the dragon, which was still in the floodplain. This was a case here back in at the end of February, where after a nice move up, it found support at the edge of the river and then was good for another, $4 or $5 on the upside. Here's an area where it fell back into the river and found support at the Bollinger Band mean, another one at the mean, and then it's been very strong since then. So this is just part of normal breathing. It would be very strong if it found support at the edge of the river, strong if it found support at the Bollinger Band mean. If it got all the way to the bottom of the river and found support where it was back here on 188, it would still be bullish, but it would really make it suspect all this buying pressure that was up here would appear to be premature, and we really can't be uber positive until we get above this about 196 and make a new swing high above the real body of this last move up. Still, this is a bullish excursion after 50 or 60 days of sideways chop, and this little head fake to the south and then gain momentum and go. A recovery to this point and then a resumption would be very favorable. But you can see the jaws of PPO, the percent price oscillator, have closed after this nice run up, and the market is no longer overbought. It has almost come down to the edge of oversold when it found support. The fact that it found support sooner, I would take as a strong sign. You can see the last time it did that here at the end of May, it gave us 20 days of really nice movement up. We're in the green zone, so intraday I want to have a long side bias. That's the first sign of strength. I'm willing to buy intraday. If it were to fail below 192 and basically out of the 30 period regression channel, it would be in the yellow, and then I would wait to see intraday market direction. I would not have a directional bias intraday. If it fell below 184, that's where I would pick up a short side bias and then be ready to sell on weakness each morning. You can see on ADX it's up around 25. The bulls are still in charge, but the bears have made a nice little recovery these last 4 days. But again, this is normal breathing, and let's see where it now finds support. The fact that we were able to close with a higher low and a white candle is a favorable indication for the week ahead. ETF regional report, all of the indexes are on a buy signal, so that keeps us at 100% invested. EFA at 58 strength is stronger than the S&P at 57, so we've now shifted to a global orientation. And among the U.S. indexes, it's the S&P at 57, technology at 56, mid caps at 55, and small caps at 52. The two strongest sectors in the world right now are ILF, Latin America, and emerging markets at 65 and 61. The fact that they're in the green is important because that's taken in the context of the 1300 ETF base. So that's a very strong performance by those two indexes indeed. The two weakest are U.S. small caps and U.S. mid caps. That's been a while since we've been able to say that. We'll see if this global orientation continues. And since those are two kind of risk-on candidates, it'll be interesting to see if they can play catch-up. Among the S&P sectors, the energy sector is clearly of great strength, as is technology, XLK at 59. Weakness in healthcare and discretionary and financials. World market model, only the large caps and then mid-cap value are above average. The rest of the U.S. is below average. Latin America, emerging markets, and Brazil had a great week. Continued to be strong. World Cup, Asia, less Japan, is above average. You see all the countries in Asia are above average or well above average, except Vietnam and China. Spain leading the way despite that poor showing against the Netherlands. And then it's a virtual tie between the global and the U.S. business sectors, with the slight hat tip probably going still to the globals on healthcare and utilities, but to the U.S. on technology. ETF top 30 reflects the same kind of strength that we saw in the blended monthly look back. Russia is in a very interesting position here. Green on strength, red on consistency. They're benefiting from two macroeconomic trends right now. One of them is that they are not Iraq, and that geopolitical interest is shifting away from the Crimea as a hotspot to the decaying situation inside Iraq, which really looks bad. Does not look good. And if the insurgency continues to move south, that puts a lot more oil at risk. That makes Russia's posture in the economic markets globally in a much better position, and they've made a nice recovery in their ETFs, and that accounts for this green and red reading here in the Russia capped index fund. And the market vectors Russia ETF RSX is one that we've been trading and tracking just for that reason. You can see the emerging strength in emerging markets here, green and white. Semiconductors and natural resources, green and white on the strength and energy. Master limited partnerships, green and white. International dividends, green and white. Hedged international equities, emerging markets equities, green and white. So you can see this is a broad-based shift to the emerging markets here. Among the Dow 30, Cisco has moved to the top here. Just an extraordinary move in Intel as well. We're going to take a look at their chart here in a minute. But the weakness down here, Pfizer, Nike, Goldman Sachs. Visa may be turning around here with a yellow on strength and a red on consistency, while IBM continues to fall. Yellow on strength and white on consistency. So that's going in the wrong direction. United Tech moving up the stack. Merck falling down in the stack. Travelers and Intel and Cisco will get our attention here, and we'll see some charts. Just liquidity stats for you on the most liquid ETFs. Shifting to the daily. Bull quiet, no signals in channeling and overreaction. A handful of channeling and overreaction among the large caps, and a certain number in the auto framers. Lots of 551W candidates. That's sort of the primary pattern of the market right now. Plenty of auto-framed candidates, lots of good frog numbers in here, and also quite a few RSI2 values. So things like Home Depot should be of interest. RSI2 value of 2, frog quality number of 3, 3.2 to 1 on the auto-framer, number 2 on the max pain range compression, and it's both channeling and overreaction, so you have to love that. And I just want you to notice this brilliant move here in Intel. An amazing response. Among the ETFs, again, a handful of auto-framed candidates, plenty of 551Ws. That's the primary condition of the market, and that says if the market takes out Friday's high, then the way is clear for a good swing trade to the upside, and it should go up and test 195.5 again. That's how I'll be trading it. Here's stats on the auto framework. Now this is a new one. The regression line fractal framework, or the RLFF, is a new framework that we've been developing. I think it works very well on swing trades when we look at it on daily charts, but it also works very well intraday using 1-minute charts. So we'll take a look at some of those charts in the members webinar later this evening. But what this shows is for each of these four populations, the Dow 30, ETF 130, the ETF 100, excuse me, S&P 100, and the NASDAQ 100, the ones that are ranked 1 to 5 are based on this reward to risk ratio, or the opportunity ratio, as we've been calling it. And this tells you how many ATRs this symbol is above, is below its 270 regression line. And so it's a 7 ATR move from where price is back to the long-term primary trend. So Pfizer, Visa are of interest for that reason. And then the ones on the bottom here are ranked in descending order of opportunity ratio. And so this says that Travelers is 8.11 ATR above the 270. So the reward to risk is always measured as a function of returning to the long-term trend line. So this will tell you essentially which ones are the very strong relative strength leaders. These are ones that are leaving the long-term regression line behind. But if that move fails, how far is it back to that 270? That tells you how many ATRs. And so you'll see, we will certainly take a look at Travelers and Intel and Pfizer, so you can get a sense of what those look like on the chart for framing purposes. And so what I'm doing on this set is, this will be part of the standard daily setup now, is you'll get 5 candidates from each of those. Each one of them is worth looking at. Each one can be framed in a favorable way. This 30-day regression line chart also happens to show you very nicely the typical 551W market condition, that price, the first 5 is that price closed higher than it was 5 trading weeks ago, or 25 days. And then the second 5 means that it's lower than it was 5 days ago, so you can see that we've got a pullback. And then the 1 in 551 means that it closed with a white candle, which you can see. And then W means there's at least a 2-to-1 retest of the high, of the 10-day high, using range risk. So what we have is a perfect pullback with the first day of momentum already built. And in the S&P, I like that it made a higher low and closed a white candle. So that's the weekend trading report executive summary. The webinar tonight is going to take a look at some interesting charts. This is just an example here of Vodafone. Let me get this in here for you. So Vodafone was actually number 1 on the NASDAQ 100 with a 15 to 1 reward to risk ratio. So that tells you how far below, how many ATRs below its 270 it's actually sitting. And so the 270 regression line doesn't show on this one, but you, the ATR percentage, 15 ATRs above is where that regression line can be found. And if we put that in on free stock charts, let's see what we can see. Now we've shifted to a daily. And so what you can see on this one is the pink line is the 270 period regression line. You can see just how powerful that move over the last 2 years has been. But now lately this pullback from 42 down to 32, which is a 25% retracement, has now been enough to roll that 270 over, and it's now starting to fail. And now you can see that the ribbon, which is a 30 period Bollinger Band plus or minus 1 on the 270, has now opened up to the far side. Throughout this entire move up, you can see that was on the downside and acted as a noise buffer for the move up. But now that this has crashed below, you can now see the 270 rolling over and then this noise zone up here. Well, it's 15 ATRs from where price currently is, right around 33, all the way up to a price at 39.50. And that's why that comes out on a 15-to-1. And so if we were to look at that even closer, you would see this is the opportunity that the opportunity ratio finds. For those of you that like candles instead, this is what that would look like. I'm actually preferring the ribbon. It's less noisy. And I do want to take a quick look at Intel while we're here, just so you get a feel for how strong that move in Intel really was. So in Intel now, the distance between price and this rising 270, see how it's pulling away? It's starting to improve. The 90 is sloping up, and the 30 is up, and the 10 is up. That's about as strong as it can get. Now, can it hold that? I don't know. But that's almost 6 ATRs above. So if we come over here and look at Intel, it's 5.26, a negative 5.26 opportunity ratio. And so what that means is a reversion back to the mean, back to the 270, is a little over 5 ATRs in Intel. And that's how strong that move has been. So that's how you read that chart. Anyway, that's the weekend report executive summary from Tortoise Capital. Is Ken Long. Keep your risk measured and your powder dry.